up, everybody? Welcome aboard to Trading with Bubba. And of course, markets once again shrug off any bad news. It doesn't matter. It doesn't make sense to me. But the terrorist attack in Israel, markets broke hard and then soared higher and continue to soar this morning. You got a big week for data. You got the CPI and PPI and Fed minutes, and you got retail sales, and you got earnings starting. And the markets know no fear. I guess there's no inflation, and I'll guarantee you that number they give you, whatever it is all BS, because you and I both know that 3.7 as a CPI and inflation is total garbage. Because obviously, I believe that we're all spending more than 3.7% more this year than last year, or this month than last month, on goods and services. Now, of course, the way the number is calculated, it is calculated without food and energy. So what are your number 1 and 2 uses that you have? Food and energy. Oh, well, it's a good thing that those aren't counted in the inflation data. But as we take a look at markets, okay, S&P is reaching a resistance level. My guess is it should fail from somewhere around here. Obviously, there's no guarantee, but the trend is still down. This little bounce was something we talked about last Thursday. If you remember, I said to you that I would expect the VIX to bounce and trade over 20. Okay, and it did. All right, I would expect it to then probably sell off a little bit, which it is. Now, again, these spike ups in the VIX, if you understand the VIX index is an index that is determined by options trading, not by whether they go up or down. Okay, but if we look at the top strategies and options, the number 1 almost every week is call buying. Okay. Number 2 almost every week is put selling. Okay, so the calculation on the VIX index is options that are bought to open versus options that are sold to open. So if only the first of the top strategies is to buy, the rest of the next 5, the top 5, are involved in selling to open. Selling to open, whether it be calls or puts, drops the VIX lower. That is, the VIX is calculated on buy to open versus sell to open. So when you hear about the fear index in the market, the fear is not that the market's going down. The fear comes in with the VIX because there's no longer put sellers. The put sellers turn into either non-sellers or put buyers, along with call buyers, which still stay the same. And of course, the VIX rises because we've lost a number of those sell to open positions. Okay. But in the meantime, the VIX is still higher, and there is still a lot of indication that there's a lot of troubles with the market. Now, again, I know they're higher now, and I'm not going to argue and I'm not going to fight the tape, nor would I tell you to fight the tape. I think that you have to continue, in my opinion, is to, like in our option trading, we set up a lot of neutral trades, okay? We set up a lot of trades. I use a lot of weighted double diagonals, which give me direction in either side, okay? So I can take anything, and just for example, you got JP Morgan that has earnings coming out Friday. Well, let's just say I want to make a trade here, okay, double diagonal. So what I would do is I would look to sell the near, which is the 13th. So let's say I want to sell, the expected move for this week is about $5. I'm going to sell the 148 call, and I'm going to sell the 142 put. I'm going to buy, let's say the 150 call. I'm going to buy the 140 put, and then I'm going to weight this with the dated options. Okay, and I'm going to take the date out to November. Okay, all right. So now I've got a position looking here, which is going to cost me $7.61. Okay, I'm long 2 calls. I'm long 2 puts. I'm short 1 call. I'm short 1 put. So based on, if we talk about delta, we talk about anything in this trade here, we are neutral right now. Okay. Now, why would I take the trade out that far? Well, the first reason I would take the trade out that far is that I've got a number of weeks to sell the premium. Okay. Now, I know that the premium is very highly dated right now for this earnings because there's a lot of people trying to buy straddles and strangles, which is ridiculous because you're playing much too big of an expected move for JP Morgan. Okay. So now let's just use for an example. So now I'm going to say, okay, so I sold these. Okay. And I've got this business. It cost me $7.59. My actual risk to this trade okay, if everything went 100% against me, okay, mathematically, there's no way that I could lose this much, but mathematically, the maximum amount of risk in this trade is $9.59. Okay, how is that calculated? It's the debit I'm paying to begin with. It is the $2 spread risk on either side. Okay, but of course, if you understand options, you know that if one of those sides pins, okay, that's the only way I could lose the maximum, and that's if I did nothing for the next, how many days is the next expiration after this one? If I did nothing for the next 5.5 weeks, which you know that we're going to do something every week. But so now we look at this. So we've got the base position on. So let's say that JP Morgan comes out with earnings on Friday and it's gangbusters. The stock goes to 160. Okay. That makes these calls worth an intrinsic value around $10. Okay. So if I could actually sell one at $10, okay, if it goes there. And now I own the trade for free. The rest of the trade for the next 5.5 weeks, I own for nothing. Okay. Let's say it goes the other way. Let's say it goes down to 132. Okay. Well, now my put is worth $8. I could sell the put and lock in a profit once again with 5.5 weeks for the stock to potentially reverse. So there's obviously a lot more to this, but just the general idea is I have that going for me because I know that there's going to be market movement on Friday. Now, should there not be market movement, or what else I have in my pocket? Well, right now I'm short in premium. I'm short the 148 call, which is trading at $1.79. I'm short the 142 put, which is trading at $1. Okay, so let's say I'm short $3 in premium. Now, for now, that doesn't mean anything. But now what I'm going to do is I'm going to take this and change this trade a little bit now because I'm going to show you how I'm going to roll it forward. So this week comes and goes, and so I go to next week, okay, and I'm going to take the short options that I'm short now. I'm going to buy those back, okay, and then I'm going to resell the same for next week. Of course, they're not traded. Just when I need them to be traded, they're not traded. Oh, I'm sorry. I got you. There we go. That's my bad. My sloppiness. Hold on. Okay. So now I'm going to get a $1.08 credit next week. So now my overall debit from $7 and change goes down to $6 and change if nothing happens. And I'm going to get to roll that each and every week going forward for 5.5 weeks. So let's say for 5 weeks, if I can collect $100, $120 a week or so for 5 weeks, that brings my cost down to almost nothing. So all I need is one or two movements outside of the range in the next 5.5 weeks to make some real good money. If it stays inside that range, I can still make more money because I do know one thing right now. Okay. The options that I'm rolling forward right now that I'm showing you are extremely overpriced. And this credit will rise after next week. After this Friday's over, the rolling credit will be higher than $1.09. Okay. In fact, we can try to simulate that by going to making these the 20th. Okay. And making these the 27th. Okay, now this is with 2 weeks to go in the premium sum. When it all comes out, this will be higher in price. Okay, so I've got a big move in my favor in either direction. Okay, I've got an opportunity to make money no matter what happens. Okay, and I got a chance to catch a big runner. Okay, now the perfect scenario would be that this week, this Friday, it would explode one way or the other, get me out of the trade in full with a big profit while I still can own 5 options left over. I've got 6 options in total on a one lot. I could still own 5 options in total, meaning that I can still roll in the middle for credit. Okay, I can still roll this. I'm going to roll this every week no matter what. And God forbid I would get lucky and the market would give me a reversal and go back the other way. So what I've really done is I've set myself up with a trade that could be profitable on Friday with a free roll for 5.5 weeks with zero risk, only an opportunity to make profit. Okay. That's just a trade to think about. It's something that we do. I use them all the time because they almost always work. You know, nothing works 100%, but I will assure you that under any condition, whatever the debit or the risk that you take to begin with will always be reduced as you go forward. Okay. That is a guarantee. Okay. Because there has to be, if you think of it from a mathematical standpoint, okay, if we get a big move, these calls or puts got to be worth something more than what I own. And since I own two, they have to be worth more than something. If they aren't worth more than something, then the guts that I'm rolling every week has to be worth something. So as you can see, under any circumstances, I'm going to be able to make money, or at no worse, be close to break even. Now, the only time a trade like this struggles, okay, especially in a stock like a JP Morgan or one of those that will lose the volatility real fast, is should it go, let's say my long calls were the 150. Let's say it runs to 153 and stops. Okay, I'll get some of that credit because I'll roll up the one of the options. Okay, so I'll get some of the money, but it'll be much harder if it stays in that area. It will be much harder to collect the extra premium. I'll collect some, but I won't get anywhere near what I would get if it stays in between. Because what happens there in that case is the long option, the short options that I'm selling, the short options now have too much intrinsic value, and the extrinsic value of the other ones that don't have any value lose value much faster. So the credit becomes smaller, but yet I will still be able to reduce the overall burden of the trade and still have a chance to get out. But again, that is the only bad part of that type of trade. If it runs to a price that isn't far enough to get you out, okay, at a profit, and it stops in that area, because it destroys a lot of the premium throughout the rest of the trade. Okay. And I know that, not a lot of people are here, but if you have questions, you can always email me about this, because I do about 15 or 20 of these a week. Okay. That I'm always carrying a number of positions just like this. I mean, I use the SPYs, I use the Qs, because those have 0 data expiration. So those are fun to use. We use a lot. We're always carrying 15 to 20 positions just like this, because in the environment of the market that we're in right now. To me, it's better to be more base neutral on an options trade than to be overly committed one way or the other. Okay. And I think what you have to look at is, you have to look at where you are within your chart. Okay. And you have to look and say, well, okay, so where do I stand? So if we look at the major indices right now, just to get a gauge. So the S&P looks like it may be trying to break out. Okay. Well, we'll see if it can hold, if it'll go. Okay. Right now, I'd look for a spot to be a seller until further notice. I mean, it's very light volume. There's a lot of reasons to believe that this is a phony short squeeze rally. The NASDAQ is still got a little bit more to go to resistance. 15,400 is probably a pretty good resistance level. The Russell is right at resistance right now, but 1,800, let's say. And the Dow, which is right at resistance, which is, let's say, 34,000. So those are things that, to me, after this rally is a little bit too sharp, right? The speed in which it's going up indicates that there's a little bit of squeeze going on, or probably a little bit of panic going on right now from the buyers who were short. If you go back to Sunday night overnight trading, now I'm not recommending that you trade overnight, but when the markets reopened on Sunday night, crude oil was exploding higher. The markets were getting creamed. And then suddenly, yesterday, about, I don't know, mid-morning or even earlier than that, let's just go, we can actually show you. Okay, we can look at a hourly chart. Okay. And if we go back and we can see yesterday, okay, here's Wednesday, Thursday, Friday, Monday, here's Friday. Okay, here's Friday, here's Monday. All right, Sunday night, markets open down big. Then yesterday, about 8 in the morning, 9 in the morning Eastern time, markets started to go higher, and bang, 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 up they went. Okay. So again, there is no reason for that. But again, we don't tell the market what to do. The market is absolute. The chart is absolute, which is why it's very important for you to watch and look at the footprint that the market leaves, whether it be Apple. Now, Apple's got to go to 180. Looks like it may want to try to break out. Amazon is breaking out. Okay, so probably an opportunity. Okay, what is the main difference between The 0 day expiration is simply trading any option. Well, the 0 DTDs are very nice because they're every day. Okay. And if you remember one thing about option premium, the sum total of the daily is always greater than the sum total of the weekly. The sum total of the weekly is always greater than the sum total of the monthly, and the sum total of the monthly is always greater than the sum total of the quarterly. So if you can sell them every day, you're getting more premium to sell them every day. Okay, I hope that answers your question. But obviously, I could wait the last expiration, but I get one trade. If I get every days, I've got in one expiration cycle. If it's a 5-week cycle, I've got 20 days to sell premium, not one. Okay, does that make sense? Let me know if that makes sense to you. But again, so the objective here is to sell as much premium as you can, but also to have protection on top of that premium, right? I don't sell naked options for the very reason that there's really no benefit to me to take the type of exposure or risk to sell naked options. I know a lot of people do it, and hey, but I know too many people who have blown themselves up and out of the market trying to trade naked premium. Okay, and there's really not a legitimate reason to trade naked, because certainly you can cap off your risk by selling a wide spread. I mean, here, I'll give you the best example. Let's use Apple. Okay, let's just say a lot of people like to sell puts in Apple. Okay, so I want to sell puts in Apple. I'm going to sell the 175 put for next week, 94 cents. Okay, all right, fine. So I'm going to get 94 cents credit for selling that. But what if I did that, but also took and added a put to buy? Okay, so now I'm short this one, which is the one I want to sell. Okay, now I can make this whatever I want. So I'm gonna take the 155. So I can get an 88 cent credit versus your 94 cent credit. Okay, but the difference is that you have a margin requirement of about 17,000. I've got a margin requirement of 2,000, and at 9.5% interest rates for margin, do you want to be on the hook for 9.5% at 17,000 or 9.5% at 2,000? Okay. Plus the fact that, have you ever seen a stock go down more than $20 in a day? You're sure you really want to buy it? You know, that's always the excuse of selling naked. But that's why I want to buy the stock anyways. You sure you want to buy it if it goes down $30? Is that really what your objective is? Okay. So again, based on expenses, based on interest rates, based on risk, it's a hell of a lot better to sell the put spread than it is to sell the naked put. Same goes for the calls, right? I mean, you know, calls have some juice in them, but of course there's always that fear for the unknown. Well, you know, let's say you want to sell the 180, let's say the 182.50 call for next week. Okay, great. Okay, so I want to sell this short. Well, okay, I got to come up with a lot of money for margin. I've got unlimited risk in theory. Well, what if I just said, okay, so I'm going to buy the 195 put. Okay, so I'm getting $1.21 instead of $1.24. Okay, and I've got, instead of unlimited risk, I've got $1,250 risk. So again, I ask you, which is a better way to make the trade? Okay, that's really the best thing to do. Hold on one second, please. You know, so I think you have to use what's in your repertoire, and not only is trading about making money, okay, not only trading about making money, but it's about not giving it away in places you don't have to give it away at. Okay, it's about not taking a risk that you don't have to take. Okay, you know, very important to understand the risk dynamics in the trading world. You know, very few people ever think about what if, and I'm a big fan of what if this happens. What if on Monday, yesterday, the markets would have collapsed off of the Israeli news? What if? Now again, they didn't. They rallied back, and it was a great, as it turned out, it was a great buying opportunity. But what if? You know, I traded on the floor in 1987. I traded on the floor in 2001, and I traded on the floor in 2008. And at some point, we're going to get that what if scenario going to come, and that these markets aren't going to come back at some point. Again, I'm not telling you to be bearish. I'm not telling you to sell markets right now. I'm telling you that there is 100% probability of a major meltdown in these markets at some point. Okay. And that's got nothing to do with my opinion. That is just facts over the years of history that they always come up. Okay. Now we've had dramatic warning signs throughout. Okay. That are telling us that the economy is not as good. And it appears that the only reason markets are holding up here is because of the overflow of cash that was put into the money supply. But that's going to run out at some point too. Again, when you slow down business and you slow down industry and you get inflation going to Pluto, okay, and you've got a Federal Reserve that instead of trying to let the free market solve the problem, they are trying to intervene with their interest rate policy. We already know that there's a record number of banks lined up at the emergency lending window, which tells you that the banks are over leveraged. Now, who gets to pay for the bank for when the banks get busted again, and the Fed says they're going to make it good? Who gets to pay the bill? Who's the real lender to the banks? Oh, the American taxpayer. Okay, so between our American farmers getting destroyed, okay, with the high cost of fuel and the low cost of selling. I mean, grain markets continue to get hammered, okay, and yet here we are, okay. So there's a lot of warning signs that are out there. Now, again, doesn't mean it has to happen today, and I don't want anybody to take my opinion, okay, or what you might hear or see on TV. I'm telling you fact. We're in a recession, okay. I don't care what the economists on TV say. We're in a general recession, okay. Fact, we have a lot of issues. Now, again, does that mean that they have to relate or translate to the markets today? No, they do not. Okay. They don't have to, they could take a year to get there. Okay. But I'm telling you at some point here, there's going to be, because again, this is not new and this market is not different than other markets in the past. We are significantly overvalued to what the market should be. Okay. There are far too many question marks out there for the market. Now, that doesn't mean that you shouldn't buy. Look, if you're looking at a chart and the chart has a buy signal on it based on the way that you do your trading, okay, then you buy it. Okay. Listen, there's no reason that you can't buy. If you see some reason, I mean, if I'm looking at Amazon, I'm not a seller, I'm a buyer. Okay. And to give you full disclosure, I'm always long. Okay, I don't ever sell away from my retirement account, from my IRA, from my profit sharing. Okay, I just hedge that stuff. excuse me. Using options. Okay, I hedge that so that I don't have to worry about when the next meltdown comes, and that I can actually accumulate some more stock. Because again, no matter what I tell you here, okay, I am a believer in the stock market of history. Okay. The markets in history have gone up 8.5% year over year. So I don't expect that to change, but that doesn't mean that there has not been a lot of bumps in the road on the way. Okay. And I think that is something that you have to take note of. Okay. It doesn't mean that you should be a predictor and try to figure it out when it's going to come. I assure you this, you will have plenty of time to react to the market when the sellers show up. Okay. It is never a one-day wonder. If it is a one-day wonder, it wasn't a true sell. You have to get a reason to get short and then to stay short. Just because you hear bad news does not mean that is time. The footprint in the market will show you that it's time. I mean, the perfect footprint to look at right now is if you look at the bond markets, okay, either the bonds or the notes. There is the perfect market. Now you have plenty of time. This has been going down for almost 8 months, 6 months. Okay. And every rally has been able to sell. And I assure you that if we get into that downtrend that I'm talking about, you'll have ample opportunity to sell it. What most people don't realize is everybody panics. They all want to get in now. But I assure you, and I'll go back to 2008. Okay. The markets had huge rallies in 2008 at the end of the year after the big selling began. The market didn't actually bottom until March of 09. Okay. We went down to 12,000, got a rally back to 15,000. I assure you, there will be opportunities for you to sell when it is time. There is no reason to be early. This isn't a party. It's not a cocktail party. This is a business. This is money. You don't have to be the first one there. Okay. The problem is too many people try to be the first one there, and then they get panicked out and they can't take the pressure. And then when they finally get forced out, it happens. Just like it is my opinion right now, we're seeing a major short squeeze. And when that squeeze is over, I think we fall hard. But because bear market rallies are the most vicious rallies there are anyways. So it's up to you to take care of yourself and be very careful and not try to anticipate what the next movement is, but let the charts. Right now, in the short time frames, all the indices are going higher. Oops. All the indices are going higher, okay, in the shorter time frames, okay? The euro currency is going higher. The only thing that is at a lower right now or is flat is the is crude oil. But that had such a big move, you would assume that there'd be some pullback or some selling. Again, the best thing you can do for yourself, okay, is to relax and not try to force the next trade, okay? You can use trades like I showed you earlier, the weighted double diagonal. It's a neutral trade. There's very little exposure to it. They're not always going to be big winners, right? Even the winners are not always big. But you have a plan, you have a defensive mechanism to reduce the overall risk of that trade on a weekly basis. And sometimes during the week, you'll get moves big enough to roll one of the extra options, which we'll get more into on another call because we're running out of time here. But again, it's the opportunities are created, but most unfortunately, many of us don't wait for the opportunities. We put ourselves in jeopardy before we ever get the chance. And we've taken ourselves out of the market before we had a chance to profit from the market. And I think I'll end it up on that. Have a great day. Just be careful. The bottom line is, it's a very tough trade right now. Markets are very thin. Volume is very light. We'll see you back here on Thursday. And until then, have a great day, everybody. Thanks so much.